Welcome to this explainer. Okay, today we're unpacking what is easily one of the most stressful, chaotic, and, let's be real, financially terrifying events in the entire logistics industry. We are talking about the ultimate nightmare scenario, a high-value refrigerated load gone totally wrong. Look, if you haul freight, manage risk, or run a trucking business, you already know the stakes. A single mistake here doesn't just cost a couple $100. It can literally bankrupt a business overnight. So let's dive right into it. Put yourself directly in the driver's seat for a second. Imagine you're hauling a refrigerated load, highly sensitive stuff, and let's say it's worth $180,000. You've been driving for days, you finally bump the dock, open the doors, and the receiver takes one look, checks a temp monitor, and says the words every single reefer driver dreads. The load is rejected. Just like that, in a split second, a massive financial bomb has gone off. And man, the panic sets in instantly. Your phone is absolutely blowing up, right? The broker is calling, demanding answers. The receiver is standing firm. There's no way they're taking that freight off your truck. Your insurance agent is now in the mix. You've got hundreds of thousands of dollars suddenly just floating in limbo. And the one burning question everyone is aggressively trying to answer is simply, who pays for this? Well, to understand the anatomy of this disaster, we first have to understand the fundamental nature of the cargo itself. See, the core risk really comes down to what's inside the trailer. Dry freight? It's generally pretty forgiving. It's temperature independent. I mean, if your truck breaks down for a few hours hauling a load of paper towels, the paper towels are going to be perfectly fine. But refrigerated or reefer freight? It is incredibly highly sensitive to both temperature and time. Whether we're talking frozen food, fresh produce, meat, or life-saving pharmaceuticals, the cargo's entire value depends on strict temperature integrity. A tiny mistake here doesn't just damage a few boxes, it completely destroys the whole shebang. So what exactly triggers this chaos? Well, a rejected load simply means the receiver flat out refuses to accept the freight. But the reasons for this are hyper-specific. Rejections are usually triggered by temperature deviations, obvious spoilage, contamination risks, late deliveries, or even just a broken security seal. Once that rejection happens, the financial chaos is locked in. Let's look at a real-world example of just how fast this goes south. $145,000. Think about that number. That was the massive cargo value of a shipment of frozen chicken in a real-world reefer claim scenario. The driver hits the road, everything seems totally fine, but during transit, the reefer unit silently shuts down overnight. The driver doesn't notice it right away. And that one missed detail, it sets the stage for a total disaster. Because when that truck finally arrives at the delivery dock, the receiver checks the temperature. Now, this load of frozen chicken required a strictly maintained temperature of -10 degrees Fahrenheit. But the delivery temp? It reads a dangerously warm 18 degrees. The receiver instantly rejects the entire $145,000 shipment. The chicken is deemed completely unsafe. And once again, we are right back to that million-dollar question, who is legally and financially on the hook for that massive bill? This triggers a crazy domino effect. The second that rejection happens, a rapid chain reaction fires off. The broker is notified instantly. They call the shipper, the cargo owner gets involved because, well, their product is ruined, and most importantly, the insurance companies are put on high alert. This is not some slow, bureaucratic process. It happens aggressively, and it happens fast. Because these claims are so incredibly expensive, insurance companies don't just take anyone's word for it. No way. They launch aggressive forensic investigations. They know exactly how high the stakes are, so they dig deep into specific targets. They're pulling the temperature logs, they're scrutinizing the reefer's maintenance history, they check the fuel levels, they are analyzing driver actions, dispatch records, and verifying the exact delivery timing. Basically, they are actively hunting for any sign of negligence. And finding that evidence? It's easier than you'd think. Modern reefer units act exacting like an airplane's black box. They track literally everything. Temperature history, unexpected shutdowns, specific alarms, fuel levels, even exactly when and for how long the trailer doors were opened. The insurer will download this data immediately. In one specific case, the downloaded data showed a reefer alarm had gone off 6 hours earlier, but the driver ignored it. That single data point shifted all the liabilities straight to driver negligence. Section 1. The top causes of cargo failure. Breaking down exactly where it all goes wrong. Now that we know how hard these incidents are investigated, let's uncover who or what the specific villains are causing these six-figure losses. $280,000. This staggering number represents the loss on a single shipment of pharmaceuticals. The cause? Mechanical breakdown. A compressor failed, causing the temp inside the trailer to rise gradually and silently. Mechanical failure, whether it's a bad compressor, a faulty sensor, or airflow issues, is one of the absolute biggest risks out there. It's exactly why insurers relentlessly examine your preventative maintenance records to see if the breakdown could have been avoided. But actually, not all failures are mechanical. Some are purely frustratingly human. This point right here often surprises new drivers, but forgetting to put fuel in this separate reefer unit is a remarkably common cause of complete cargo destruction. And trust me, insurers investigate fuels levels extremely hard, because running out of fuel isn't seen as an accident, it's considered poor management. To put a very real price tag on that exact human error, $110,000. In this real-world claim, a driver simply forgot to top off the reefer unit. It shut down overnight while they were sleeping, and an entire load of premium frozen seafood spoiled. The investigation swiftly determined this was preventable driver error, which immediately kicked off a massive coverage dispute over who was left holding the bag. So operational choices matter immensely here. Take your thermostat settings, for example. You've got continuous mode, which gives you uninterrupted airflow, and you've got start-stop mode, which cycles on and off to save fuel while keeping a general temperature. Well, highly sensitive loads, like pharmaceuticals or specific produce, strictly require continuous airflow. Simply pressing the wrong button and running a load on start-stop instead can cause temperature fluctuations that ruin the entire shipment. One wrong button press. And speaking of strict rules, we have to talk about the trailer doors. A broken security seal equals immediate rejection, period. It doesn't matter if the freight inside is still perfectly cold and looks pristine. If a driver stops during transit and pops the trailer doors just to visually check the cargo, the receiver's going to see that broken seal and reject the load entirely based on the risk of contamination. This is especially rigid with food products and medical supplies. And remember, time is just as dangerous an enemy as temperature. Here's a $65,000 loss involving fresh strawberries. The temperature inside the trailer was actually fine, but the truck broke down, delaying the delivery by 14 hours. Those 14 hours caused the fresh strawberries to arrive spoiled and overripe. Boom, shipment rejected. Time sensitivity matters heavily, and insurers will look deeply into dispatch communication and roadside response times when this happens. Section 2, the insurance exclusion trap. Assuming you're covered is your biggest financial risk. Up until now, you might be thinking, well, yeah, it's a huge loss, but that's exactly why the carrier has insurance, right? Well, let's talk about the twist in this narrative and why just having a policy doesn't automatically mean you're protected from bankruptcy. Here is arguably the most dangerous assumption in the entire refrigerated trucking space, the belief that spoilage is automatically covered. I'm here to tell you it is not. Many standard cargo insurance policies contain hidden exclusions. They will flat out exclude coverage for things like mechanical breakdowns, improper temperature settings, driver negligence, or leaving a malfunctioning reefer unit unattended. Tragically, truckers often only find out about these exclusions after the disaster has already happened. To actually be protected, a carrier must have something called a reefer breakdown endorsement. This is a very specific additional coverage added to a policy that explicitly covers refrigeration failure, spoilage, and temperature deviation. If you're hauling frozen foods, your unit malfunctions, and the insurance company finds out you don't have this exact endorsement, your claim is getting denied, and the carrier faces a devastating six-figure out-of-pocket loss. And hey, even if the claim is covered, the long-term hangover is severe. Look at this painful reality. After suffering a few reefer spoilage claims, one carrier saw their insurance renewal premium jump from a pretty manageable $38,000 a year to a back-breaking $94,000 yearly. Brokers start losing trust, underwriters view you as toxic, and some insurers will simply refuse to cover your reefer operations entirely. The stakes are huge and they're long-lasting. So how do you survive this minefield? How do the smart carriers actually protect themselves? 2 words: ruthless documentation. Document every single temperature reading. Keep every single reefer fuel receipt. Log meticulous pre-trip checks and maintenance inspections. Record your seal numbers. Take clear photos of the cargo. And above all, sit down with your insurance agent and ask highly specific questions about exclusions and spoilage coverage before you ever accept a load. I think this quote perfectly summarizes the core philosophy you have to adopt to survive in this space. Reefer freight is not just transportation, it is cargo management. You aren't just moving a box from point A to point B anymore. You're acting as a mobile, high-tech warehouse manager. Moving refrigerated freight requires treating the cargo, the equipment, and the documentation with absolute scientific precision. We've seen how fast a single ignored alarm, a forgotten fuel stop, or a hidden insurance exclusion can obliterate a business. Which leaves us with this final critical question to evaluate your own preparedness. If your reefer unit shuts down tonight, out in the middle of nowhere, with a $250,000 load in the back, are you absolutely certain your policy and your procedures will save your business tomorrow? It's a question you really need to know the answer to before you turn the key. Thanks for joining me for this explainer, and keep learning.